Hey, what's up guys? It's Ezekiel Chiu here. So, let me hit you with this. Most traders, they think that the support and resistance is as simple as drawing a line and waiting for price to bounce at the area. But that's why they get crushed. So price doesn't respect the lines. It tests them. It fakes through them and then it flips into traps. So if you do not know how to read the story behind the level, you are just a bait for the market. The truth is that support and resistance, they are the backbone of trading, but only if you know how to trade it the right way. And that's what I'm breaking it down today. I'm going to show you the reversal setup that flips rejection into profits. Breakout play that turns ceilings into new floors. I'm going to show you the fake out trap that wipes out the crowd but pays the pros. The multi-time frame playbook that is going to cut through the noise and show you the zones that really matter. And if you stick with me to the end, I'm going to share with you a bonus tool that I use to confirm whether a level is about to hold or completely break. So once you see support and resistance this way, you never look at your charts the same way again. First thing first, support and resistance are where the real fight in the market happens. So these are not just lines on the chart. They are zones where the buyers and the sellers, they go head to head. And that's how the market, and what is the market all about? It's all about buyers and sellers. So when buyers is more, the market is going to go up. When the sellers are more, the market is going to go down. At any one point in time, that is what is deciding the market direction itself. You may ask,
Ezekiel, so how do we use this there? And why is it so important?
Is that these areas, these lines, these zones, they repeat and they repeat over and over again. Price, they react at those levels, and that's what makes them so powerful. So if you know how to trade them right, you're gonna stop guessing, and if you start stacking the odds in your favor, things are gonna change. And this is exactly what this entire video is about. So now let's go. What if I told you the market, it literally leaves a lot of free money here and there on the chart itself, but only traders who know where to look for actually cash it in, right? So that's why the first play in this playbook is what I call the reversal setup. So think of it like this. Price, it comes to a zone. It stalls there and then it snaps the other way. If you can spot this consistently, this is money, right? This is money right on the table itself. Now, here's how it works. So the first thing you want to do is you want to see multiple rejections. If price has bounced off the same area 2 times, 3 times, or even 4 times, this is not accident. It means that zone is strong and really strong. So for example, if the market keeps finding the support and it keeps shooting back up after hitting the support, you know that the buyers, they are defending that area. Pro tip, the bigger the gap in between each touches, the more powerful the rejection is going to be. Don't just stop there. Multiple touches are good, but they are not enough. So the next thing you got to do is to wait for confirmation. So price doesn't just touch a zone and then magically it's just going to bounce off. You want proof. So one of the go-tos is a reversal candlestick pattern at that level. So what it could be? It could be a bullish engulfing candlestick pattern at a support level. It could be an evening star at the resistance level. So this is your first sign. After seeing the touch, you see the candlestick pattern. After finding a candlestick pattern, which by the way, there's a lot of different kinds of candlestick patterns, watch my candlestick pattern playlist where you're going to see all the different candlestick patterns available out there. And there are a lot that is not the commonly known ones like engulfing candles, etc. Then, once you spot it, the candlestick pattern over there, this is good, but still not good enough. You want to stack it one more time with another confirmation. So this is what you could add: a moving average break. For example, you add a 20 moving average over there, or you add a 50 moving average over there. Depending on the pair itself and the time frame, you want to find a moving average where price respect it the most at that period in time. That could be the 20 moving average or the 50 moving average where price is holding that move. This is where I really lean in. So now, candlestick pattern plus moving average plus that strong multiple touches, big gap zone. When it breaks, this is high probability of this trade working out and heading the other way. So now, after having all this confirmation, multiple confirmations, it comes the execution. So the entry goes right after the confirmation. For your stop loss, you don't let it be so tight. Give it a little bit of breathing room, just beyond whether is it the resistance level or it's the support level itself. So now, take profit, here's what you're going to do. It's pretty straightforward. Aim it at the next key level on the chart itself. Support bounces back to resistance. Resistance, it falls back to support. And when you have a strong resistance zone, for example, it's going to reverse, and it's going to reverse pretty far, and you're going to reverse down all the way to support, and you're going to have an insane risk to reward ratio when all these are stacked together. Now, this is how the playbook works, because the price shows you the rejection, it gives you the confirmation, and then you pull the trigger. So this is very structured and it's repeatable. Reversals, they are not the end of the story, right? There's not only one way to trade the market in using support and resistance. The market structure is... Market structure means what? Means how the support and resistance, they evolve over time. And that's where the O levels, they flip. So when, for example, the false breaks, they trap the traders, and how the bigger picture, it frames the whole move itself. So I'm going to break down all these things. So in this structure, we have three important things that I'm going to discuss with you. First thing that you need to be aware of is breakouts. Hey guys, Ezekiel Chiu here. So if you are doing prop trading or you are interested in it, right, one of the most frustrating things that you can face is delayed payout. Now here's the good news. This is where funded trader markets have been making waves. They have introduced a new approach that is giving traders more control and faster access to their earnings. And that is on-demand payouts. So traders are receiving payouts in an average of just 2 hours after hitting their goals. And if a payout is not processed within the 24 hours mark, they are going to double your payout. So what's even amazing is that they also have a 100% profit split. So meaning that traders can keep everything that they make. No hidden cards, no surprise fees. Say they also offer low spreads, 1:100 leverage, swap-free accounts, and support for multiple platforms like MT5, CTrader, MatchTrader, and TradeLocker. So now, if you're a crypto trader, the markets are open 24/7. So you can even trade them on the weekends. Plus, they have round-the-clock chat support whenever you need. So now, despite all of these features, funded trader markets is still one of the most affordable funded programs out there. So check out funded trader markets, links below. When price, it smashes through, right? When it breaks through, the resistance tells us that the buyers are now in full control. The momentum is strong in the market itself. So that old ceiling, that old resistance, it can flip into a brand new floor, a brand new support itself. So the same is on the other direction itself. When the support, it gives way, the sellers take over, and that floor is now becoming a new resistance, which is a new ceiling itself. The flip is where the opportunity lies. Most beginners, they panic when the level breaks itself. They never expect the level to break. So they are trading rejection trades or reversal trades, right? When price hits the resistance and then they're going to go down. But when it breaks, they're like, oh shit. They think that they are wrong, they get shaken. But the pros, we wait. Because more often than not, impulse is not going to work here. It may work at times whereby jumping in right away, it may work at times. But if you run through trading the long run, the best way is to wait. More often than not, the market will come back to retest that broken level, and that's the golden moment. So now picture this, the resistance break, price runs up and then it drifts back down. It tests that old resistance, which is now acting as support, and then it shows bullish momentum. That's where we strike. So for example, this pair has an old resistance, right? That it broke, right? And on the retest, it did not collapse down. No, it held there. The buyers, it defended that zone. And then came a strong bullish candlestick, breaking through the recent high. So that is the green light. So entry goes on that retest. And then you ride the trend in the new direction. The breakout playbook is all about turning what looks like chaos a broken level into a structured order. When you understand this, you never fear breakout again. So for this, I would highly suggest that you watch my video on pullbacks itself next. When there are breakouts, not all of the breakouts are going to be real and can be trusted, because that's where the fake out they enter. Right, so now, the market, it loves luring the traders in with, oh, this is going to be a breakout. So when traders enter on the breakout, only what happens next? It flips the script and then you trap them and then it goes back down. Fake outs, they are not like, it means what? Oh, it's a failure. Shit, then you take a loss. No. They are a profitable setup itself. Fake outs are setups and a very profitable setup. So now, if you are not trading a fake out setup, you're missing a whole lot of money over there. When everybody is on the wrong side of the trade, they thought it's a breakout, but then they fake out, then they get stopped out and they are done. This is where we step in and we take the other side of the trade. Price would poke above a resistance and then makes you think that the level is broken and then snap back down into the zone itself. That is not failure. Like I said, it's an opportunity. So fake out are the market way of testing like the trader's conviction. So here's the trick. The bigger the panic from the crowd, the bigger the opportunity for you. Why? Alright, so for example, if it's a big opportunity where it's a breakout, a lot of people are watching the market, a lot of people entered the market, they buy it, and then the market went back down. A lot of people get stopped out. When a lot of people get stopped out, it also means what? A lot of buy orders are being closed, which triggers the sell orders, and that's what makes the market tumble downward. Everybody is cutting losses. Not only everybody is cutting losses, they're rushing to exit. New selling orders are coming in as well. This creates a massive momentum downwards. Get it? This is how we want to capitalize on this. The step to trading a fake out is simple. We wait for the confirmation. So don't enter the moment that price, it breaches the zone and come back, for example. You want to look for signs that the market is rejecting the breakout, like a reversal candle, a fake momentum spike or a rejection wick at that zone and then come back down. Once the rejection is clear, enter the trade in the direction of that snapback, right? Whichever direction it is. Place a stop loss just beyond that zone, right? And it's not going to be really far off. And then you aim for the next strong level on the opposite direction. So you now know that the fake out trap is not a failure in the market. This is a high probability setup. It teaches you on how to use the market tricks against itself. So the next time you see a breakout that looks too clean or too tempting, don't get fake out. You trade that trap itself. So now here's the thing. Fake outs are just also one piece of the puzzle. When you put them together with reversal and with breakouts, that's where the support and resistance, they really come alive. Okay, so now I'm going to build this playbook with the final piece. The third one that you need to know in this structure is about always seeing the bigger picture no matter what. So that's why using the multi-time frame is critical. It's going to make or break the trade itself. Quick pause. If you found this video helpful so far, here's something that always surprises me. 73% of you who watches this video regularly haven't subscribed yet. I mean, if you're getting value and want to support what we are doing, the best way is just to hit that subscribe button. It's free and really helps us to continue creating better content for you every single week. It truly means a whole lot to us. Okay, now let's get back to it. The real edge comes from trading. It's not for you to zoom into the small picture, like you trade the one time frame, you only trade the 1 minute, the 5 minute, or the 1 hour. That's it. You focus the time frame. No. The real edge in the market, it comes from where? It always comes from seeing the bigger picture. If you see a single time frame itself, it's like zooming in too close to the photo itself, and you're gonna miss the whole story of what happened. When you line up the support and resistance across multiple time frames, you're gonna filter out the noise and focus on the zones that the market truly cares about. Here's why this matters. A level on the 5 minute chart might look important. But if you zoom out to the daily, that level disappears. It's just noise. It's not important level at all. The real edge is not on the 5-minute chart. It is in the bigger picture itself. For example, a level that is drawn on the daily time frame or on the weekly time frame, that's where the big money, the institutions, the banks, the fund management companies, etc., all the big companies, all the big players, they are paying attention at those critical higher time frame levels. They make their decision based on the higher time frame levels as well, because these are serious money. They don't speculate. They trade with high probability, high conviction, and that's where the zone lies itself. So now, when you combine that with the lower time frame reaction at the level, you are stacking the odds. So this is the essence of multi-time frame. So you use the higher time frame to set the map, mark the zones, and then you drop to the lower time frame to find the timing to enter itself. If the support is supposed to be strong, why does it break all the time? If the resistance is so powerful, why do you still get fake out? It's not because support and resistance, it doesn't work. It's because most traders, they mark the wrong level on the wrong time frame, and they wonder, oh, why did the market slice through them so easily? All right, so now here's the thing, okay? Support and resistance, they are not random lines. You don't want to randomly draw them a lot in the lower time frames. You can draw them, but you draw if it tallies with the higher time frame. That's where you know if a lower time frame support and resistance level matches the higher time frame support and resistance level, that is also confluence. That is multiple time frames stacking together. But if you got a support resistance, let's say you got support line, just one touch on the lower time frame doesn't really mean anything in the higher time frame. That is just noise itself, because the market moves in waves, right? It goes up, down, up, down, up, down, up, down. You cannot possibly be marking every highs or lows in the lower time frame. It will not work out that way, which is why it is key to only map the higher time frame zones as the high probability ones, and you take the trades reaction of the lower time frame at the higher time frame reaction zones itself. Here's where the bonus comes in, right? Here's where I show you how to add the final edge in the market itself. So how do you know, say, if a breakout is a real breakout or a fake breakout? You add the MACD, the MACD. The histogram in the MACD, it tells you the momentum, and it's like a lie detector for the candles itself. When price breaks a level with huge spike in volume, right? The volume, it can be a histogram in the MACD. With taller, bigger, taller, dark bars, that is conviction of the market. There's strong volume right now, there's strong momentum right now. This brings it the higher high, the break of the higher high with stronger conviction. This is where the breakout is more likely to work. The market is behind it, the crowd is behind it, the momentum is real. But if price breaks the previous high, the break of structure, with a weak or falling volume, a faded color histogram, that is a red flag. That's where you hold back. That's where you don't trade the breakout. Because why? You're probably going to walk into the trap. So instead of trading the breakout, what are you going to do? You trade the rejection, or you wait for the fake out. And if there is divergence in the MACD compared to the chart itself, this is where the fake out and the rejection comes into play even more itself. So that's where you know the break is not real and it's a fake out trap. For this, if you want, watch my MACD video where I go in depth on how to use MACD the right way itself. Get it? Let's put it all together. In the beginning, we started with the reversal setup. That is super powerful. That's the cleanest way to catch the market when price rejects a rejection level. That is like a bread and butter play. And once, if you have patience, and then you wait for the confirmation trade, and then you enter it precisely. And then we talk about the market structure, which is the three important things, right? The breakout, because not every level is going to hold, right? When a ceiling can break into a new floor, that's where you trade the pullback itself. And that's the beginning of the trend itself. And then what? We talk about flipping the script with a fake out. Like most traders, they like, after the breakout fails, they give up. No, the fake out is one of the best highly profitable trades out there. You got to learn it. And then we talk about, like I said, I have to tell you about the multi-time frame, because if not, you're going to have so many lines in the market. It just does not make sense itself. So therefore, support and resistance level, check the higher time frames on and focus on them, and then enter using the lower time frame confirmation. And then finally, I show you how to add the MACD for final confirmation, and then you couple it with the histogram plus divergence. Once you see this picture, right, you're going to add it and put it all together. A single thing itself is powerful, but when put it all together, it gives you the full game plan. It gives you the structure, the backbone of trading using support and resistance. Good? Okay, so here's what to do next. I want to give you something that's going to change the way that you trade forever. So I've put together a free training that walks you through the exact 3-step system that I use to find high probability trades with sniper level entries, real risk control, and zero guesswork. So this is the same system that I use myself, and the same one that has helped thousands of traders go from frustration to consistent wins. And I'm giving it to you for free, right? There's no fluff, no fueler, just pure strategy. So if you ever wanted to trade with clarity and real conviction, this is the place to start. So click on the link in the description below, and I'll see you inside the training.